We're dealing with some big numbers here in this video. Microsoft surpasses $3 trillion market capitalization and exceeds Apple as the highest market capitalization stock in America and perhaps in the world. Now, in this video, I'm going to answer if Microsoft stock is the better buy instead of Apple stock. Is the surge in Microsoft stock's valuation too much and it's time for Apple to catch up? Or is there more room to go for Microsoft stock? So I'll look at that in this video and compare these two giants on critical financial metrics to determine which one I think is the better buy going forward, even after Microsoft already passes Apple in market cap.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So look at these giants here, their market capitalization over the last 10 years. They've grown significantly from roughly 700 billion market caps for each of these two around 2015. They've now grown to nearly $3 trillion market cap as of this recording. Fortunately, I've had the pleasure of owning Apple stock. I don't know precisely when, but sometime around 2015, 2016. I've owned Apple stock since then, so I've had the pleasure of some nice capital gains in Apple stock. But I'm not saying that Apple stock is the better buy. It's still too early in the video for that. You're going to have to wait. I'm just highlighting that I do own Apple stock and have owned it for some time. So the first metric I wanted to highlight is the operating profit margin. If you compare Microsoft with Apple, you'll notice that Microsoft is significantly more profitable. Microsoft's operating profit margin at 43% is way ahead of Apple at its operating profit margin of 29.8%. And given that a larger percentage of profitability comes from Apple's let me rephrase that. So given that a larger portion of Apple's sales comes from hardware versus Microsoft, which has a much more significant portion of its sales coming from software, I suspect Microsoft will continue to lead Apple in terms of profitability for several years into the future. The next metric I wanted to highlight is cash flow from operations, but this can be a confusing subject, so I made a little video for you to watch on that here. Take a moment, watch this video, and I'll see you on the other end. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Now that you've got a better understanding of how cash flow from operations works, let's take a look at Microsoft compared to Apple in this metric, and you can see again Microsoft leading way ahead of Apple in this metric, 43.5% compared to 28.8% for Apple in this metric. Let's also take a look at the next 2 years, the prospects. So according to Wall Street, they think Microsoft will grow revenue at 14% in fiscal year 2024, and earnings per share will grow by 15% in the same year. In 2025, they think Microsoft will grow another 14%, and earnings per share will increase to 18.8%. So if you look back at its 3 fiscal years, 2023, 24, 25, analysts expect Microsoft earnings per share to grow at an accelerating rate. The second derivative is increasing. And if you've been viewing my channel, you know that that's a very positive sign for investing in a stock. Not only is the earnings increasing at a healthy 15% rate, but that rate of increase is increasing. That's important. That's a positive characteristic I'm attracted to when I'm looking at investments. Apple, meanwhile, is expected to grow revenue at 5.6% in 2025 and then another 6.6% in 2026. Its earnings per share are expected to grow at 8.9% in 2025 and another 9% in 2026. Apple, like Microsoft, is expected to increase its earnings per share at an accelerating rate from 7.6% in 2024 to 8.9% in 2025 to 9.0% in 2026. Similar for its top line revenue growth of 3.5% in 2024, 5.6% in 2025, and 6.6% in 2026. So an accelerating growth rate in both its top and bottom line. Excellent for Apple stock investors. Although what you noticed is Apple's numbers, the absolute numbers, are much lower than Microsoft. At 3, 5, and 6, and 7, 8, and 9, they're much lower than Microsoft expectations of 14% growth for revenue and then 15 and 18% growth for earnings per share. Sorry about the glitchiness of this website. So even though they're both increasing, Microsoft is increasing at a faster rate, nearly double, more than double the rate of Apple. And then Microsoft is also increasing its bottom line, at least at an increasing rate. So finally, I wanted to take a look at their valuations. And according to the forward price to earnings ratio, Microsoft is more expensive at a forward PE of 31.29 compared to Apple with a forward PE of 27. However, everything we looked at, Microsoft was superior. Better operating profitability, better cash flow from operations to sales, better prospects for revenue over the next 2 years, better prospects for earnings per share over the next 2 years. And all of that being considered, the valuation is only slightly above that of Apple at 31 compared to 27. So with all that, I would choose Microsoft as the better stock to buy compared to Apple. Even though it already surpassed Apple with the 3 trillion market cap, I think Microsoft has more room to outperform Apple in 2024 and beyond. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.